Hey, this is Morgan Housel from Fool.com. Joining me today from the NASDAQ is one of my favorite financial writers, CEO of Ritholtz Wealth Management.
Yes.
Barry Ritholtz, thanks for being here today.
Thank you for having me.
The largest debate in the circles that I think you and I travel in right now, the S&P is up 150% in the last 4 years. And for most of those 4 years, people have been saying too far, too fast, valuation stretched. That group is growing into a chorus now.
Yes.
People saying new stock
It's
market
a bubble.
New stock market bubble. What do you
New
say to that?
highs. New highs are so bearish.
What do you say to that?
There are like 6 separate arguments in that. We could take them one at a time. The one that I'm hearing lately is new highs aren't bullish. Turns out that's absolutely factually inaccurate. You go back through history and you see how many new highs we've had. Take the Dow Jones since 1897. We've had something like 1,300 new highs during the average secular bull market, 1982 to 2000, 1946 to 66. And whenever this next secular bull market starts, I don't think it started yet, but maybe history will say it began earlier this year when we broke out of the prior trading range. You average about 30 new highs a year. If you were a seller on new highs, 30 per year from 82 to 2000, you left a lot of money on the table.
So it's almost like we've had 13 years of up and down and boom to bust. So now it's like we're trained that new highs mean new bubble. But stocks are supposed to be at all-time highs. That's what
Well,
stocks
I don't know if they're
are supposed to do.
supposed to be, but
We're supposed to make money over time, over the long run.
over long haul. The other argument I've been hearing has been this is a bubble. Well, when was the last time that the general public or the financial media called a bubble in real time, other than as a contrary indicator? Remember the famous covers of both Time and Fortune of Why We Love Housing, and back in 2005, literally within days of the all-time high in real estate. You look last year, or maybe it was 2 years ago, in Barron's, where to invest in bonds right now. Everybody loves bonds. Here's where to put your money. A week from the all-time high in bonds, the all-time low in rates. So I don't really see the mainstream media or even the financial press as being astute enough to identify a bubble in real time. If you want to talk valuation, that's a really different story.
So let's talk about valuation. You have the Cape valuation right now.
Right.
At about 25. So based on some historical averages, that looks pretty stretched. What do you say to that?
So that's a fair complaint, a fair issue if you're looking forward at 10-year returns in the U.S., right, which is one market and it's only one measure of returns. Merrill Lynch did an analysis of 18 separate valuation measures, and it was Cape and it was Tobin Q and it was a whole run of stuff. Out of the 18 or 17, 2 were significantly overvalued. The rest were fair valued, slightly elevated, slightly cheap. So I find people are cherry picking. That's the other thing about, you and I both write a lot about psychology.
Oh, yeah.
There's and confirmation bias. People are going out and finding stuff that supports their pre-existing conclusion. The most important thing to understand about valuations is that it's a 2-variable equation. And what that means is there's price and there's earnings. And everybody looks at it as if it's a static ratio. It's not. Stocks, by the way, stocks by the metrics that I tend to favor, price to sales, earnings growth, dividends, we're moderately overvalued. But if you go back through history, you could be moderately overvalued for 2, 3, 4, 5 years. Look at 96 to 2000, a 5-year period. The market screamed higher. The NASDAQ tripled. The whole period of that time, they're overvalued. But this is a mistake that people make. Stocks can come back to fair value one of 2 ways. Either the stock prices come down, or heaven forbid, the economy gets better and earnings tick up. And we're starting to see signs of that in Europe, where stocks are much cheaper, and in emerging markets, where stocks have gotten decimated over the past 5 years.
But that's part of the bearish argument that people make, is that earnings might be inflated now too, with margins near all-time high. That's not necessarily an argument that I buy. What's your take on it?
So it's possible that earnings are inflated. We're definitely at a high in earnings relative to GDP, but we got to put that into a little bit of context. We have a post-credit crisis GDP recovery, which, as Reinhardt and Rogoff warned us way back in 2007, post-credit crisis recoveries, subpar job creation, subpar consumer spendings, subpar GDP. So this is kind of what you should expect when we have the type of collapse that we had in 08, 09. Mediocre, just above stall speed, 2.25%, maybe 2.5% GDP. Not 3.5%, 4.5%, not the sort of robust growth we saw in the bubble years, and whether you want to call that 98 through 2000 or 05 through 07, but the 5% growth, you don't get that without a real bubble. That's the other thing that I find astonishing is, wait, you think that we have a full-blown bubble and it's 2% GDP?
7% unemployment?
There's no doubt that housing has gotten frothy, but remember, housing got utterly shellacked, and you could find specific stocks, whether it's Bitcoin or Netflix or Apple or gold, or go through the list where you get this favorite sector or this favorite issue that runs up. We call it Cape Matterhorn. You see it go up and then you see it go back down. Yeah, you're going to find that. But overall, this is a market that, assuming, and this is a big if, assuming the economy picks up, assuming hiring accelerates just a little bit, imagine if wages go up a little bit. Now, granted, you're fighting a decade-long headwinds, globalization, robotics, computerization. We become much more productive, much more efficient, and it's really easy to do with 1 or 2 people what used to take 10 people. That's certainly tamping down wages, but it's not unthinkable that as this recovery continues, earnings could potentially accelerate. I don't eliminate the possibility that, hey, maybe people are right. Maybe we are at a cyclical high. It really depends on how effective companies are at generating new business, new revenue, and new profits.
So do I take it that you're fairly bullish right now, or are you just advocating humility when we're talking about valuations?
Well, we always advocate humility. You never want to piss off the trading gods because they'll teach you what an idiot you are in a heartbeat. That said, our clients, they have a long-term perspective. Our average client is somewhere in their mid-50s. Their portfolio is a couple of $1 million. And their big concern is not the next 10 to 15% correction. Hey, we would love that. That would give us a great buying opportunity. But rather, their concern is, if you're 40 to 50 years old today, there's a real possibility you're going to live past the age of 90. And longevity just continues to accelerate as time goes on. There's a genuine concern that even with a couple of $1 million, you can outlive your money. So the thought process is, let's not worry about the next 6 months or a year. We think in terms of decades on behalf of their portfolios. So it gives us the ability to look past the next correction. Now, if we saw a situation like we did in 07, 08, and I was excoriated for being too bearish, the Dow 6800 study, that was really just what's fair value of the Dow? We calculated it at 9,800 at a time when the Dow was 13,000 and said, hey, if everything that we see happens, and the Dow breaks 10,000, well, you could get a 3,000 point panic from fair value. So we got dumb lucky, 6,800. Hey, 65.
Like it was 6,600 or something.
Yeah, let's close enough for government work. The funny thing was that wasn't a forecast. It was really just an analysis, and nobody wanted to talk about why each of these stocks appeared so overvalued to us. It was really just, how do you get 6,800? That's crazy. That's a 50% drop. Well, you get 50% drops all the time. We had it in 2000. We had it go back to 73, 74. Go back. This is not a complete and total rarity. In fact, I think if we look at the Dow back to 1897, there have been 11 drops of 30% or more. That's a full-on crash.
Right, and stocks fall 10% nearly every year. But
when
we talk about it, we treat it like it's the end of the world when it happens.
That's right. And what's hilarious to me is people are complaining there hasn't been a pullback in 12 months or 14 months. Actually, you go back to 2011, you had from, I want to say May to November, I may be getting that range wrong, you had more than a 20% correction. And that's a bear market. And so if you really believe the historical metrics, well, this isn't a bull market that dates back to March 2009. This is a bull market that really dates back to the end of 2011. 20% correction, a bear market, granted, was only 6 months or so, but still, 20% is 20%. If you want to look at it that way, it's not that we're 52 months or that long in the tooth. hey, this is a market that's been running for about 2 years since the last short bear market.
You had a post yesterday on your site where you asked your readers to make their bear pitch.
Yes.
Were any of them convincing, and which ones?
It's not that it's convincing or unconvincing. It's I'm looking for the thought process of what is driving markets and where the risks lay. So every now and then you get a comment that I think is, silly and not intellectually defensible.
A silly comment, Barry?
Those on the internet. I love the XKCD cartoon where you come to bed. No, I can't. Somebody's wrong on the internet. I love that. But one of the comments is, this market has been totally driven by the Fed. Really? Totally driven by the Fed? Not companies with really clean balance sheets, enormous stock buybacks, and reasonable increases in dividends, and earnings that have recovered from their lows 140%. Any one of those justify a pretty substantial move off the lows. When we look at markets that have been really shellacked, down 50+%, a snapback rally off of that sort of level, median is about 70-75%. But the range is anywhere from 30% to 200+%. So we're up 150-something%. It's on the far end of that range, but it's within the range of what we've seen before. So the big question to me, the fairest complaint is, hey, how is the Fed going to unwind QE and ZIRP? And what is that going to mean for the economy, and what is that going to mean for the stock market? To me, that's a wild card because we're in uncharted territory. We've never been in this sort of situation where rates are this low, the Fed is stimulating the economy as much as they have been through QE, or stimulating various asset classes. It's arguable how much QE is really impacting employment and GDP. I think you can make a pretty good case that they've helped the auto sector, they've helped the housing sector, they've helped any area where you're buying something with credit because rates are so low. We turned in a car on a lease and ended up picking up a new car for about the same dollar amount. We got a car that cost 50% more. The purchase price was 50% higher than the car that went back in March. Because rates are so low, that's a huge part of that sort of credit. So stop and think about what it costs to lease a car that's $10,000, $20,000, $30,000. It's dirt cheap compared to what it was 3, 4, 5 years ago. Huge boon to the auto industry.
And there are 2 times that the Fed stopped QE1, QE2, in I think 2010, 2011.
Right.
And during both those periods, interest rates actually fell. So
That's
we're
right.
talking about before about advocating humility. And I think when QE ends, to say when it ends, this is going to happen, is a very difficult game to play. What do you think about that?
That's right. You end up with a situation where very often the bond market is trading ahead of the Fed. So just the mere talk of taper in May, we saw the 10-year go from like 1.6 to 2.6 back in May. We're somewhere higher than that today. I think normal rate on the 10-year is somewhere between 3 and 4%. Even that arguably is fairly low. Look, you could get a 30-year fixed mortgage today for between 4.25% and 4.5%. If you haven't refinanced yet, I don't know what the hell you're waiting for. You better make sure you have an income and a decent credit score, but that's money sitting there waiting for people to reduce their monthly expenses with.
So when we're talking about market pullbacks and we're talking about opportunity, why do so many investors, almost all investors it seems like, fear market pullbacks and talk about them like it's something to worry about when we know historically that they've been incredible opportunities? And I just think back to 2009 to 2013 today. We've 150% rally in 4 years. Why are people scared of that happening?
There are a couple of reasons. First, I think the biggest one is that humans are emotional creatures. It's a natural tendency to react first to your faster response, which is typically adrenaline, stress, nervousness. I can't tell you how often you hear the phrase, I don't care what it costs, just get me out, I can't take it anymore.
You hear that from your clients?
Not from our clients, because our clients we do a lot of behavior modification. We really train them to understand, here's how often this happens, here's what you should be looking for. Your goal is not to beat the market this year. Your goal is to make sure that you don't run out of money in retirement. So here's your target. We try and work backwards. What do you need to retire? Well, based on what you have, I think we can get you 30% more. What does that do for you? It allows you either to leave money to your kids or donate it to charity or maybe do more traveling. But instead of getting stuck in the grind of how did I do this quarter, look, statistically, we know the best and the brightest. Look at the hedge fund guys. They've been underperforming the market for 1, 3, 5, and 10 years and getting paid handsomely to stink the joint up. It's pretty astonishing. So rather than try and chase alpha, which seems to be a expensive waste of time for 98% of the investing public, we like to say, let's look for streams of beta. Here's the beta we're getting from the US stocks. Here's the beta we're getting from emerging markets. Here's the beta we're getting from non-US markets, which typically means Japan and Europe. And then you can look at other asset classes like real estate, like dividend stocks, really not quite its own asset class, but somebody who wants to be a little more cautious, a little more risk averse, that's an option. There are a lot of different things you can do. We're pretty underweight bonds, but if you look at munis, they're paying a nice dividend and it's tax-free. And if you look at corporates, granted, if you do the Apple deal or the IBM deal, you're getting paid nothing for a long period of time. But there are plenty of A-rated corporates that are throwing off 4.5%. So there's a way to get a half-decent yield, and it really depends on what you want to do with this asset class down the road. Are you looking for this as retirement? Look, if you need the money in 2 years to pay for college, that's a different situation. Right. But again, the bulk of the clientele we work with, they have retirement needs that are decades off in the future, and we really try and explain to them, I don't even look at daily charts. Everything we do is weekly, and there are days when someone will ask me on the train home, hey, what'd the market do today? Oh, I don't know, I forgot, I didn't look at the close at the end of the day. Why is that? Because the day-to-day stuff is noise. We want to smooth it out and think longer term. And you could go back through history and say any rolling 5-year, 10-year, 20-year period, there's never been a rolling 20-year period in U.S. history where equity returns were negative. Now, if that 20-year period is 1 or 2%, that's not really good. But the idea is that you have a broad allocation of different asset classes. We never know each year what asset class is going to do the best, but we own a little bit of all of them. And so when something in the world is going up, we take advantage of it. I think that's the lowest risk, lowest volatility way to go after returns rather than chasing whatever the hot name of the day is.
So speaking of chasing the hot name of the day, we were talking about hedge funds earlier. Mm-hmm. You wrote a post recently about hedge fund returns. They're pretty dismal on average. And you laid out some reasons for that. Their size and fees and whatnot.
Right.
My question is, if on average hedge fund returns have been so disappointing, why are investors still throwing money at them hand over fist?
It depends on the investor. If you're talking about the big pension funds, they get to work with their accountants and say, what are our expected returns? Well, our expected returns for bonds are this, and for equities are this, and for hedge funds are this. Even, I don't know how they came up with the number for hedge funds because they haven't hit that number in a decade, and it's not an asset class. You know, with stocks and bonds and real estate and commodities, mean reversion applies. Hedge funds are a legal structure for trading various assets. So people seem to be looking for a hedge fund mean reversion. I think it's not mathematically supported. So that's the institutional error. The individual error is it's kind of sexy. It's all over the financial press. It's all over financial TV. They're 2.5% of the total assets out there. They dominate CNBC. They're on Bloomberg TV a lot. They just make for really interesting filler on television. You look at guys like Bill Ackman and David Einhorn, really smart guys, really interesting guys. Neither of them has especially hit the cover off the ball the past couple of years, but they're compelling television. And let's be blunt, most financial television is not valid information for investing. It's infotainment. And with that as your backdrop, it's no surprise that they're not making money for anybody. The last factor is just straight across the board cognitive biases. The illusion that you have the ability to pick a manager who's going to outperform in the future. Humans just can't do that. We can't do that with mutual fund managers. So far, it seems that none of the fund-to-funds can do it with hedge fund managers. And from what I've seen, individual investors and the biggest and best and smartest pension funds have not demonstrated an ability to do that with any consistent regularity. We can easily tell you who are the best performing hedge funds for the past 10 years and 20 years. Which number is bigger? Here's Renaissance Technologies, and here's Bridgewater, and here's Maverick, and you go down the list of hedge funds, and hey, the first 50 or first 100 have been killing it. But there's 10,000 hedge funds.
Right.
It's
you
like
never hear
mutual
about
funds.
those.
Yeah, that's before we start to get in the fact that 25% of the hedge funds each year go away, and new hedge funds try and find a new hedge fund name. They've all been taken. Every Greek and Norse and medieval god, you can't find a name for a hedge fund because we've probably gone through 50,000 hedge funds in the past 20 years.
And most of the good ones probably don't want your money anyways, right?
Yeah, Renaissance Technology, Jim Simons. Just a side note, when undergraduate I entered Stony Brook, applied mathematics and physics, left poli-sci and philosophy in my senior year, but the outgoing mathematics department chairman was Jim Simons. If you met this guy, you would never in a million years think of giving him a dime. He was a chain smoker, he had a ratty beard, he would step outside the physics department, outside the math department, have a cigarette. If you saw him, he's the last person on earth anyone would think about giving money to. Then you find out he was a code breaker, and he was this, and he was that, and you end up with just a tremendous intellect and a brilliant way of expressing that trade, so brilliant that a few years into his successful run of 40% a year returns, he gave all the money back to his outside investors, and now the bulk of their best performing fund is Renaissance Technology employees and Jim Simons only. No one else is in that. So here's the greatest, theoretically the greatest hedge fund manager in history. Not only can't you put money into his fund, but if you were lucky enough to do it in the beginning, he gave it back to you.
My final question, because I think we're running out of time. It seems like a lot of things are going well in the economy right now. Markets are doing well. What's keeping you up at night these days?
So there's a lot of things. I mean, I learned a long time ago not to worry about things that are outside my control. I can't control if the Senate is going to approve Janet Yellen. I can't control what happens with the European Central Bank. I can't control the profits at Apple or Google. I can't control any of that. The only thing within my control is how we express our allocation through our portfolio. So I wonder if I have enough equity exposure. I wonder if I'm overexposed to any particular part of the world or any particular asset class. We're underweight bonds. I wonder if that's still too much bonds. If rates continue to go higher, I have to think that bonds get hurt. So the things that I stress about, and there aren't a lot of them, but the things that I worry about are things that I can handle. Every time I hear somebody on TV or read something complaining about the Fed doing this, hey man, there's nothing you could do about the Fed. Your job isn't to be a policy wonk, or I should say, my job isn't to be a policy wonk. My job is to manage risk on behalf of clients who are looking for returns. So every time, and I think I read something that you had written some time ago about people complaining about the Fed and their managers. If you see a guy complaining about the Fed, what that usually translates is, I'm really positioned wrong for this rally, and I'm blaming them.
That translates to long gold 1800 or something.
That's exactly right. And so, by the way, the gold story is just a phenomenal example of cognitive bias and how investors lie to themselves. In the pursuit of alpha, not only do we often not achieve it, and in fact, most investors don't even achieve beta, meaning what the market gives you.
Right.
But if you look at the rationalization process, if you look at what people say to themselves at 1800, at 1700, at 1600, and you've seen it in Apple, look, at 700, at 650, at 600, there's this process of telling stories to ourselves to make us feel better about the really dumb things that all of us in this business do. You can't manage assets and not really screw up occasionally because you start to believe you're smarter than everybody else, and once you go down that path, usually the market will smack you pretty quickly to let you know you're not smarter than everybody else. So instead of saying, hey, I'm the next great hedge fund manager and I'm going to try and outperform everybody, if you could just generate beta, you're ahead of 90% of the investors out there.
We have to leave it there. Barry, thank you very much.
My pleasure.